Dear students, in continuation of the last video of cost of capital dividend approach or dividend valuation model, this session I will be dealing with next model of cost of equity capital, which is CAPM model or capital asset pricing model. Before getting into the CAPM model, let us go through one more problem under dividend growth model. Sometimes sometimes the growth of the dividend in the last problem which we had dealt in the last video, dividend growth was given directly. I am taking that page. Dividend growth was 6%, which was given directly. Sometimes it will not be given directly. Instead of that, continuous dividend for the last five years will be given. Let us check that thing. In the problem, last 5 years dividend is given 10.5, 11.02, then 11.58, 12.16, 12.76 and 13.40. You could find out this problem in MY Khan textbook. Current market price of share is 150. The flotation cost per share is ₹3. Dividend per share for the last 5 years is given. Assume that a fixed dividend payout ratio is there. Expected dividend on the shares is also given of the current year 14.10. They are asking you to find out the cost of equity capital. Here some new informations are there. That is flotation cost. Flotation cost is the cost involved in issuance of shares. There will be brokerage charges, there will be issue related charges, stamp duty, registration, that other charges for the issuance of shares. It is called as flotation cost. Preliminary expenses involved in the flotation of shares. Here we are also going to do the problem under dividend growth model. D1 divided by P0 plus G, which we had looked into the equation last video session. But the problem is that growth we have to find out. How do we find out? The first year dividend, last 5 years dividend is given. So the previous from 5 years back, that is first year dividend is 10.5 and the last dividend is 13.4. With this you could find out the growth. So what we do is that last year's dividend divided by the first year dividend, we will get a figure which is 1.276. Make it very clear. The beginning year dividend and the last year dividend, we will compare, we will divide, we will get a figure. This is the compounding value of dividend. So we have to apply compound value 1 rupee table from the appendix which we had used once while studying capital budgeting. Applying compounding sum of 1 rupee table. You have to see that 5 years, the dividend is calculated on the basis of 5 years, isn't it? For 5 years growth is given. So compound first table, compound sum of 1 rupee table, we have to apply and find out in the 5th year where this 1.276 will come. So in the 5th year it will come at 5%. So 1.276. So that is the growth percentage. This is very important problem. That is what, before getting into the CAPM model, I thought of taking one more problem in dividend growth model, because dividend growth will not be given directly. So we got the dividend growth. Now applying the same equation, expected dividend of the share in the next year divided by present market value of share plus growth. So expected dividend on new share is given 14.10. Present market value of share is also given. It is 150 rupees. And flotation cost, initial expenses incurred in the issue of share is given. So that should be deducted in order to check the base price of share, base market price of share or actual market price of share. We will plus dividend growth 5%. We will get the cost of equity. So this is one more problem I had I had taught for you for applying the dividend growth equation. Now let us deal with CAPM model. CAPM model. CAPM model, we will be the equation is that CAPM model is taking into consideration the risk-free rate of return and the systematic risk or market risk involved in the calculation of cost of equity. Why we are doing this thing? Why this model is so popular? This is the model which is applied by many companies because equity shareholders always have to face the market risk and the risk-free return while looking into their looking into their return for the investments they had made. So how do we calculate cost of equity capital under CAPM model? The equation is that cost of equity capital is equal to RF, R subscript F, plus this is the symbol for beta. Beta means what? Systematic risk relative to the volatility of the systematic risk in relation to the market risk, or the volatility of the price of the share relative to the market risk is called as beta. And expected market return, that is ERM, expected market return minus risk-free return is the equation for CAPM model. So let us see, let us take one example. We could see that, look into this example, how do we calculate risk-free return? Here you could see the equation K is equal to risk-free return plus beta into, here some textbooks they apply, instead of RM they apply KM. Some textbook could apply ERM. Both are same, expected market return. KM or ERM, both are expected market return. KM or ERM, both are market return and minus risk-free return. Let us see. In a company, certain informations are given. Hypothetical limited wishes to calculate cost of equity capital using CAPM model. See, the CAPM model, it will be mentioned in the question which model you have to apply. From the information provided to the firm by its advisors along with the firm's own analysis, it's found that risk-free rate, it is given risk-free rate equals 10%. So RF is given, which is 10%. The firm's beta equals, beta factor will also be given. What is this beta? Beta is the systematic risk relative to market, or the beta coefficient. B is actually it's read as beta coefficient. Beta coefficient is the measures the volatility of the return relative to market return. If beta factor is less than 1, it means that it is relatively less volatile, or is less volatile to market relative to market return. Beta is more than 1, it is more volatile relative to market return. Beta is equal to 1, the volatility is same to the market return. So which is good? Usually beta is less than 1 is good, because this is less volatile or less risky compared to the market return. So risk-free return is given, beta coefficient is given, and see the return on the market portfolio, that is also given. Market portfolio is 12.5. So applying the formula, K is equal to RF plus beta into expected market return minus RF, given directly in this equation. We are applying that thing. K is equal to RF. RF is 10%, risk-free return 10%, plus what is it? The whole of beta. Beta is given. Beta is it is mentioned 1.5 into expected market return is 12.5% minus risk-free return is 10%. We will get 13.75%. 13.75% as cost of equity capital. So this is another model of cost of equity capital. Let us take one more problem under CAPM model. See, This is the information given. Look into the question detail. 3 companies information is given. Cement Limited, Steel Limited, Liquor Limited are 3 companies, private sector company, government, public limited companies, and along with it, Government of India bonds. The Government of India bonds, that is risk-free return or risk-free investment in government bonds is also given. 4 informations are given. These 3 companies initial price, existing price of the shares is given. Government of India bonds existing price is also given. Dividend for all companies individually, dividend per share is given, or dividend of Government of India bond per basis, one bond basis or one equity share bond basis is dividend is given. Year-end market price is given, and beta risk factor is given. From this, we have to find out cost of equity capital of each company based on CAPM model. So what we are going to do is that we will draw a chart. The year-end market price which is given, we will chart it first. So Cement Limited, then Steel Limited, L Limited, and Government of India bonds, year-end market price we will chart it first. Then initial price of the shares or bond is given, that we will chart it second. We are rearranging the chart given. These are all given in the question. Given things I am putting it in double stars. Okay, so this is also given. So both the things we are taken. Dividend is also given. Okay, so individual dividend is also given in the question. That we are putting in the third chart. And here one important thing what we have to find out is what is the capital appreciation we have to find out. We cannot apply directly the CAPM formula because there are some other informations which are given in the question, that is initial price and year-end market price. Difference between the year-end market price of a security and initial price of the security is actually the capital appreciation. So we have to look into that. We have to find out what capital appreciation had happened to a particular investment. So all the shares, all these company shares, including government organization, we have to find out the capital appreciation. How do you find out the capital appreciation? Existing or prevailing year-end market price minus initial price. So 50 minus 25 will get return as capital appreciation. 60 minus 35, 25 will get return as capital appreciation. And in case of Liquor Limited, 135 minus 45 will get the capital appreciation of 90. Government bonds rupees 5 capital appreciation we will get. Now what is the total value? Total value we have to find out. Total value of the expected market portfolio is this capital appreciation plus dividend. So this 25 plus dividend, 27 for the C Limited, Cement Limited, 25 plus 2 for the Steel Limited, and this 90 plus 2 for 92 for Liquor Limited, and for government bonds it is 145 plus 145, the total for the companies. Then we will take the total return for all the companies. Now why we are finding out these things? This is the total return for the companies based on the initial price. So we have to find out RM or KM, RM, expected RM. This we are finding out in order to find out the expected RM. So expected RM is what? The total return for all the company. Why we are taking total return? Because it's on portfolio analysis. The combination of securities, what we will get the return we are comparing. It is the expected market return. So 291 total return divided by the initial price total, we will get the expected market return. Now we could apply the formula directly because risk-free return is given in the question directly. Risk-free return is 8%, which is given separately. So RF plus beta into expected market return minus risk-free return is the equation. So for every company, that is for C Limited, S Limited, L Limited and Government of India bonds, we are finding out applying the equation, but directly we could apply the equation because RF is known, it is given directly inside the question, which I am putting it as double mark, and beta factor is also given. Individual beta factor is given for all the companies. That is the volatility of the return in relation to the market return is given, that we are applying, and expected market return will be same for all because we found out using the total return and comparing the total return with the initial price total. So that is the expected market return we got, and we found out a cost of equity capital of all companies. Cost of equity capital of all companies we found out, and we could identify that it will be the highest for the Government of Equity, Government of India bonds. So that is all about cost of equity capital using CAPM model. Thank you.